Welcome to the OR Talks podcast. Here are your hosts, Neil Seeger
and Marc Jovanovic.
So, thanks for joining us. We are fresh off a 10k run.
We are.
Which was extremely difficult for Marc.
It was difficult for me, very much. I hate running, but we had a good team, didn't we? We had over 30 runners took part.
33 runners took part, which is a very big achievement. So we're quite proud of. Now, where did you place, Marc? Did you out of all about the 33?
I might have just about come first. I think there's a bit of luck in there, to be honest. But
it's not
about
luck.
the placing. It's not about the placing. It's about the charities. It was all for a really good cause.
Absolutely.
Blood Cancer UK.
Blood Cancer UK, and I think we've raised so far up to £3,000 or just over 3,000, which is something we're very proud of. Donations still open?
They are, so if you'd love to support us, that'd be great. It was a fantastic achievement by everyone. None of us were really runners that took part. It was all for the charity and
absolutely
good cause.
The charity's the winner, and that's the most important thing, isn't it?
That's it.
Absolutely. So onto tax, I suppose, and accountancy. So today we thought we'd have a conversation about something that's come up an awful lot with both of us, really, isn't it? It's stamp duty, land tax.
Dreaded stamp duty, land tax. The tax when you buy a property. Confuses
people left, right and centre. And the rules aren't necessarily as clear as we hope they would be. So I'm going to break it down a little bit and we'll see. Marc is the guru when it comes to stamp duty.
Build me up, those. Build me up. So now he's going to ask a question that I don't know the answer to.
Yeah. Well, now you come to mention it. No, you'll know the answer to this one. So effectively, if I was to buy my own residential house, just me looking to buy my own house, I'd pay stamp duty, land tax.
Yep, that's correct. Yeah.
Okay, and I'd pay that at the normal rates.
At the normal rates, yeah.
Okay.
If it's your first property, you've never owned a property before, then there's first time buyers relief as well, so that gives you slightly lower rates. And is there a maximum value on that? There is. I believe it's been raised to 500,000.
Okay, so it's about 5. So we'll use that as an example for now. Obviously, tax is always changing. So if it's $500,000 or below, as a first time buyer, I don't.
Yeah.
Okay, so I then go. Let's just say it's now me and you.
Yeah.
Okay, congratulations, you're buying a house with me, and you've already bought a house.
Yeah.
Okay, so you've already had one once before. You haven't got it anymore. You've sold it.
Yeah.
But me and you are now going to buy together.
Yeah.
I haven't bought one. You have had one before. So a lot of confusion is, and a lot of people will always say to me, we won't pay stamp duty on that house.
Yeah, it happens all the time, and couples get together and things like that, or friends.
Yeah, absolutely. Yeah.
But yeah, no, it does come up all the time. Unfortunately, if one of the purchasers has already owned a property, first-time buyer's relief does not apply to that transaction.
Okay.
So if it was just you buying it on your own, you would get it. If I'm buying it with you because I've already owned one, we won't get it.
So it becomes you overrule it really, because you've already had one before.
Yeah.
Okay. So then we both already own ours.
Yeah.
Okay. And then I want to go and buy an additional one, just me. I want to go and buy a rental house.
Yeah.
Quite common. Quite a lot of people do that. So I then go and buy my rental house. Do I pay stamp duty on that?
You do, but you also pay the additional rates. So when you already own a property, if you're buying another property without selling your current main residence, you have to pay the additional rates of an extra 5% on top of the standard rates.
So I've got a way around that.
I thought you might.
Yeah. So my way around that is I'm going to buy this other house in a limited company.
Yeah.
Because it's that limited company's first house.
Correct, it would be.
Yeah.
However, limited companies always pay that additional 5% surcharge.
So that doesn't get around it at all.
Unfortunately,
so whether I have it in my own name or I have it in a company's name, it's still the higher rate of stamp duty.
Exactly right. Yeah.
Okay. So I have one other scenario that's come up quite frequently actually. So I've got 10 buy-to-lets in my own name, sat over here. Doing
very well for yourself.
Yeah, absolutely. I like investing. And then I've also got so let's say it's me and you. And me and you have got a partnership where we've got 10 rentals.
Yeah.
And then we also have our own residential house.
Yeah.
If we went to go and move house and sell so we found a really good opportunity, and we were going to end up buying another PPR, my principal private residence. But when we buy that other house that we're going to look to move into eventually, we're going to end up paying the higher rates on that because it's another property.
Yes, The only time you won't pay the higher rates are if you're selling your current main home and replacing it with that new property. You have to be replacing the main property.
So if I had I bought on the rent, we bought on the residential.
Yeah.
But we had to do it up.
Yeah.
And there was a 3-month period where we had to do that house up. It is a replacement. It's bought to be a replacement. But actually, for temporarily, we own them both.
Yeah.
So we end up paying the higher rate on the purchase.
Because at that point of purchase, you've still got the old property. You have to pay the additional rates at that point.
Yeah.
But the good news is, you can, when you sell your previous main residence, so long as you do it within the time frame, you can reclaim that additional amount that you paid. Now, HMRC will not do that automatically for you. You have to claim it. And if you don't claim it within a year of selling the old home, then you're too late, basically.
So it's important to be hot on your dates,
and
also be aware that actually you will have to pay the higher rate initially, but you can claim it back.
Yeah, so it's something to factor into your cash flow. But yeah, you can claim it back at a later date, but you have to be on the ball and do that. HMRC aren't friendly enough that they'll just automatically pick it up.
They wouldn't necessarily know, would they?
They wouldn't. They wouldn't.
So that's only on your residence.
Yeah, you've got to be replacing your main residence.
Okay.
If you're buying another property, you're keeping your main residence to rent out, then you won't be able to claim it back because you're not disposing of your own main residence.
Because that's just effectively adding an additional rental house.
Yeah.
In practical terms.
Exactly. So that's something that does catch people out quite a lot.
And it's important to make sure that the stamp duty is right, because obviously solicitors aren't tax consultants and accountants aren't solicitors.
Yeah.
So we have to make sure actually a lot that's quite a lot of the stuff we do is actually checking the stamp duty stuff for solicitors.
Working together with solicitors, basically. So if you're buying properties, you already own properties, then it's always worth having us have a look at the stamp duty side of things for you.
And we've seen it quite a lot with the change in the rental world.
Yeah.
Actually, a lot of people are selling, but also a lot of people are buying.
Yeah.
So there's a lot of people moving properties around, so it's something that we need to...
Yeah, and it can catch people out because when you're buying a property, your cash flow is pretty tight, isn't it? At that point it can be. So an unexpected extra stamp duty tax bill is the last thing that you want. So it does plan ahead, like we always say.
Yeah, it is. It's looking at that calculation before you make that purchase, isn't it? And building that into your numbers. Because there's nothing worse than, as Mark says, you go get your mortgage, you get it all agreed, you have your deposit sat there, and then you realise you've got another $5,000 to pay out in stamp duty.
Well, there might be some simple planning that you can do to mitigate the tax, so it's just worth looking at in advance, really.
Absolutely, strategising. Yeah. That's my little word of the day, strategising. So we're having an awful lot of conversations with clients to do with this new MTD, making tax digital. I didn't say it. Put my teeth in. Making tax digital.
Everyone's loving it, aren't they? It's a nice present from HMRC for this tax year.
Absolutely, it's brand new. So it's coming with effect from the 6th of April. I think we mentioned it on an earlier podcast as well, to be prepared for it.
Yeah.
But now we're very much in that window of it here. It's happening. It's something that we need to be prepared for.
Yeah.
So just a reminder, what are the rules on that?
So you have to do quarterly submissions if your turnover in the previous tax year was over £50,000 from self-employment or rental income. If it's a partnership or limited company, you're not currently caught by it.
Okay.
It's just self-employed people and people with land and property income.
Yeah.
With income before any expenses of over £50,000.
So that could be a combination of rental and self-employment. So if I've got £5,000 rental and £50,000 self-employment turnover, that's 55,000.
Yeah.
So now I'm in.
You're in.
But if I've got £50,000 worth of rental and I've got £5,000 worth of self-employment, they're the exact same numbers, just from different sources. But I'm in because it's rental and it's self-employment.
Combined.
Yeah. So if I've got employment income of 50 grand and my £5,000 again for my rental, I'm not in because it's been less than the 50,000 from rental or self-employment.
Yeah, that's for this tax year, and then going forwards the thresholds are dropping. But at the moment, 50,000 and over
would put me in now. So my 24-25 tax return showed 50 grand or more turnover on there. That means that I'm in from effectively the 6th of April 2026 into there. So it will be my first 3 months up at the end of June.
Yeah.
Okay, so it's going to be quarterly, so June, September, December, March.
Yeah.
Okay, that comes in. So it's something that we've got to have registered as well.
Yeah, you have to have signed up, so you're not automatically enrolled by HMRC, you have to physically do that. And we're doing that for obviously all of our clients on behalf of them.
And there's various different ways to get the submissions. You know, there's a lot. There's bridging softwares out there. That's what we work with. We work very closely with our clients. So where people have got used to doing their spreadsheet and they're very, very happy with their spreadsheet, and it's great, then actually it bridges the gap between the spreadsheet and HMRC.
Yeah.
And then you've got other accounting softwares out there that you can do the work within, and also we work with the accounting softwares as well.
Exactly, yeah. And what you're doing each quarter is you're reporting your income for that quarter and your expenses for that quarter. No tax adjustments are done at that point. You don't have to pay any tax at that point. It's HMRC just wanting to know what you've had received in income and what you've spent on expenses. It's their way of looking at forecasting what tax liability they're going to get from you at the end of the year. But you're not paying tax any earlier than what you currently are. Your payments are still the same, 31st of January and 31st of July.
So they haven't changed, it's just the submissions.
Yeah, they're just being nosy basically, want to know what you've got going on earlier in the year.
That's a forecast what their tax revenue is going to be, I suppose. The same as all of us like to know what our income's going to be.
It is. And then at the end of the year, when you do your final submission, at that point, that's when you do all your tax adjustments. So things that you get added back for tax that aren't allowed, and claiming things that you wouldn't show in your normal income and expenses.
And that final submission has got the normal filing deadline of the end of January, like the old tax return had.
Exactly.
So the only thing that's changed is we've got to file these numbers quarterly.
Yeah.
Okay. Still pay my tax. I still file my tax return. Is that what's it called now? It's an end of year submission.
Yeah, annual submission or final submission. Yeah.
Yeah. So back in the old days, it was tax return, but
it looks slightly different, but it's the same thing for all intents and purposes. Any other income then gets brought in, so if you've got some employment income as well, or some bank savings interest.
So it's only from that side. None of those sources matter for the quarterly submission. No. It's just what I earn from my self-employment, my rental income.
Exactly.
Right. Okay. So that's quite important actually, and it's not going anywhere. We can't bury our head in the sand and hide away from it and hope it's not going to.
No.
But are there any penalties? What are the revenue putting in place at the moment?
So there are penalties if you don't do it. However, because it's so new and because it's a massive change for everybody, there's a soft landing with the penalties. So HMRC have suggested that they're not going to impose the penalties in the first year.
Okay.
So,
but it's always good to get it filed and
get in the habit of doing it, because the penalties are going to come in at some point. And the more accurate your quarterly submissions are, the less likely chance, hopefully, HMRC have got of looking into your return. So what you don't really want is a massive change when you do your actual submission at the end of the year.
Yeah.
Because it's just going to raise alarm bells and ask questions as to, well, hang on, each quarter you've submitted this, and then the final one you've done a massive adjustment. What's gone on?
Where's the extra come from? And it's just just makes it. And also, I suppose, from a client point of view and from our point of view, it makes it more easier to forecast what you're going to owe for tax, because you're looking at it quarterly rather than end of the year getting a shock from the accountant on the 29th of January going.
Absolutely, we can be a lot more proactive with clients throughout the year because we can have a clearer picture of what's going on. Whereas at the moment, we're always looking at it a little bit retrospectively with some clients. Having their information each quarter is going to mean, well, hang on, we've got this going on here. We can plan a bit easier with you.
Because one of the common questions we always get asked is, when do I go limited?
Yeah.
And if it's tax efficient to go limited, and we're always thinking, well, actually, what do your numbers really look like?
Yeah.
So we then go get your tax return done, and then we can assess it then. But actually, if you've got 2 quarters and you've gone over the £50,000 of the profit, actually, then we can look at the tax efficiency at that point.
Definitely, and same with the VAT registration threshold. So that's a rolling 12-month threshold. So that can catch people out a lot of the time. So seeing the figures constantly throughout the year, we'll be able to spot it if you think you're getting pretty close and have those conversations with you a lot earlier.
Because there is nothing worse than when you come to look at your tax return and you look at it in June and you look at your numbers for the rolling year and it's up to the end of March, because that's what you're looking at, and then you say, well, you've done 120,000, you should have VAT registered back in January. Well, actually, now you're 6 months down the line and you should have been charging VAT for 6 months. So, and then that becomes a real problem.
Yeah. And we're going to be able to spot those things a lot sooner. So it is an administrative burden that's been added onto you, but there will be positives that come from it as well. It's going to help us help you a lot more.
Keeps you more informed on your business as well. So actually, although it's a negative, as you say, from an admin point of view, it's not an admin it's not a negative from a business point of view.
Yeah.
It will actually give you better insight into your business.
Yeah, hopefully you can have more control over it and be more aware of what's going on in real time.
I'm not too worried about this quarterly reporting anymore. I think
it will all be
quite
fine.
nice.
2 years' time, we'll all be absolutely used to it.
It becomes a new normal.
Yeah,
it's like when VAT changed and that became MTD.
Yeah.
all those years ago, that was a big change.
Exactly.
But it's probably the biggest change for a number of years that's come in.
It is,
particularly in the self-employment world.
Yeah, probably the biggest since online filing for tax returns. Really,
yeah,
isn't it?
true. So, from paper.
I'm not quite old enough to remember that. I don't know about you, Neil. But
how do I remember?
Do you see what you did there? You just pointed out that he's younger than me. So.
You still beat me in the 10K. You know, no, you still beat me in that. But yeah, I think that's the real hot topics that I'm seeing at the moment. It's going to be your stamp duty, particularly with the changes that are coming in from your renters' point of view, which is people buying and selling properties. I'm seeing it more and more and more now.
Yeah, and just on that, if you are selling properties as a landlord, then don't forget that you've got 60 days to report and pay any capital gains tax that's due on those properties. That's only if you're a landlord selling, or it's not your main residence that you're selling. So
if you're selling the house you live in, and it's your,
it's always been that, yeah.
Then there's nothing to worry about, but if you are selling an additional property, or one that you don't live in, then it's worth assessing.
Yeah, definitely. Just let us know and we can have a look at it for you. Just whether
plan.
Yeah.
One of the other things that's actually come up, and it's coming up in conversation an awful lot, really, from a tax planning point of view, from the 25-26 year, and also from a going forward point of view. 25-26, so the tax year that finished on the 5th of April 2026, dividend tax rates were lower than they're going to be in your 26-27 year. So that in 25-26, they were, remind me, Mark.
Started off at first £500 is tax free, 0%, then 8.75%.
Yeah.
Then it goes up to 33%, and then 37% roughly. It's in simple numbers.
Yeah. So you've got effectively anything 50 grand and below.
Yeah.
Over and above your £500 allowance will be at 8.75%.
Yeah.
Then 50 grand up to your
125.
125 is the 33.75.
Yeah.
Okay. So that's gone up by 2%.
Yeah.
So now instead of having it at 8.75, I'm now at 10.75.
Yeah.
And then above your 50 and you're below your 125 is 35.75%. So when you're planning and you're looking at your payments on account and you're looking at your tax strategy planning, you've now got to provide for another 2% on your dividends. So it makes it really important looking at your accounts and looking at how that transfers into what dividends are on your 25-26 tax return and then going forward. So it has gone up by 2%.
Yeah, dividend tax has been hammered a lot over the sort of last 5-6 years, hasn't it? So big changes to it, and the allowance, the tax-free allowance, it used to be £2,000 when it was first brought in.
Yeah, it did.
Then it got hit down to 1,000, now 500. So.
Yeah, so it's really important that, particularly with that change, that if you are a limited company shareholder, you're an owner-managed limited company, that you actually build that into your planning. Again, it's based on that forward planning, isn't it?
Forward planning, yeah.
Yeah, so it's something you want to discuss. By all means, give one of us a shout, and we're more than happy to discuss it with you. But I think those are three really big hot topics and really big changes at the moment.
Yeah. If there is anything that you've come across that you'd like us to discuss in a bit more depth, just let us know. Just give us a WhatsApp on 01905 777 600.
I thought you were going to jump in and just look at me then and wait for me to say the number, because you've done that
about
before. It was the pause. So, thank you for joining us. If you do anything, as Mark says, drop us a message.
Yeah, thanks everyone. Until next time.
Thank you.